The best deal Thursdays. Hello and welcome to the Froggy Five. I'm your host, Jim Freilich, founder and managing partner of Froggy Companies. And today we have a special treat for you here. I've got Jerry Chu on the line, who is CEO and founder of Lofty AI. Let me ask you this from I want to understand staking. That's how we got to this interview too. I think I reached out because I'm like, this staking and liquidity pools, this is what scares guys like me the most, right? Because on one hand, the whole thing about tokenization, I'll say at the very top of the list is liquidity now in something that was historically an illiquid asset, right? Mm-hmm. Great. That's also it could be a double-edged sword depending on how it's handled. So when I hear about the staking and liquidity pools, being a guy that never did anything with Bitcoin and only took like a year and a half to try to understand this whole tokenization world, tell us about it, and I'll ask you. You're a super smart guy, so you're gonna have to. This is gonna be work for you here. Start with like the sixth grade level. I won't say second grade level, like sixth graders of like, okay, how this thing can work, and then tell me why it should work, what can go right, and then what the risks are, if you can, at some level.
Absolutely. Go ahead. That's a great question. And so, again, even though a lot of our technologies build on the blockchain, we actually sort of abstract that away, right? We view it in the same way as current products do. Like nobody brags about what database they're using. So it's the same thing. Like we don't really tell you too much about the blockchain. It should just work. And the value, it should just be the benefits it delivers to you as a user. You don't really need to know or understand how the blockchain works. And so staking and liquidity pools is actually one of these things where it exists and it's optional for you to interact with it, but you don't have to. So as a result, as someone who just wants to invest in real estate, you don't really need to fully understand how it works. It just delivers benefits to you, and you have to pay a fee for it. That's as simple as that concept is.
Sure.
So at a high level, what's really happening is, traditionally when you trade anything, whether it's real estate, stocks, or whatever it is, you need a counterparty, right? You're selling someone has to be the willing buyer. And that's kind of where the liquidity issue comes up, because if you list something at a price, not everyone may agree with you. And so for months on at a time, right? Like when you list a property for sale on the MLS, some properties don't sell for a whole year. Mm-hmm. So, that's why people are like, well, it's not liquid, because you rely on a counterparty to complete your transaction for you, right? So even though we made real estate fully digital, meaning that people can trade piecewise and buy and sell these tokens whenever you want to, there was still that issue of the counterparty. You might be listing 3 tokens for sale, and that's only $150. So obviously liquidity is higher. There's more people that can buy that. But at the same time, if you list it at a price that people don't agree with, the $150 of worth of order might still sit there for a month before it trades. So the way that stock markets now are very liquid is because in reality, when you make a market order, you're not actually trading with the other person sitting in front of their laptop executing an order. What happens is that there are these entities called market makers, and they basically come in and all they do all day long is they buy and sell shares of the same stock. So there's this big company like buying and selling shares of Apple, right? And so when you buy shares in Apple or sell shares in Apple, you're actually trading with this entity. And because they're doing it constantly, that's why your order goes through pretty much instantaneously. You're like, oh, okay, I just click a button and I've sold my shares in Apple. Like, isn't that great, right? Mm-hmm. You're not actually truly trading with the individual or a counterparty in that sense. And so in Web3, or blockchain in general, people created these algorithms to mimic market makers because that's what's required to keep a market liquid. But a traditional market maker, they make money from buying and selling these shares, right? Like they're not just doing this service for free. They buy your shares at a slightly lower price and then they resell them at a slightly higher price. That spread is their profit margin. And so if they do this enough, they actually make a very decent amount of money throughout the year. And they use their own money and they raise that money from investors and things like that. And that's where they get the liquidity and their capital from. So what people did was they built these algorithms that can do the same thing as these centralized market makers do. So these algorithms are just, think of it like a trading bot. It's just buying and selling tokens, shares, and whatever you design it to do, right? And it does the exact same thing and creates a very liquid market. So now all of a sudden, as a buyer or a seller, you don't need to wait for another person to complete your transaction with you. You just sell it or buy it from this bot, right? But this bot, because it's on a company, it has no capital, it has no liquidity of its own. So where does it get the money to trade with you in the first place, right? That's where these liquidity pools come in. Think of them like vaults that exist digitally on the blockchain. And these vaults accept deposits. You can deposit the property tokens in our case, and then you can also deposit USDC, which is basically dollars, but the blockchain representation of dollars, right? It's a stable coin. So you can deposit these assets into this vault. And what the algorithm is doing, it's borrowing assets from the vault to trade with people. So when you sell tokens in the property, the algorithm will actually borrow some USDC from the vault, from the liquidity pool, and it will use that USDC and buy those tokens you're selling. So now from you as a real estate investor, you're just like, hey, I clicked a button and I traded. Like it went through instantly. I just sold my tokens. Like, this is great. It's exactly like how I trade Apple shares on my brokerage account. And that's how we create this sort of instantaneous trading and this liquidity. Now, why would anyone lend assets into this vault, right? What do they get out of it? Because there's risks involved, of course, right? The reason is because, in order to use this instantaneous trading, instant liquidity, which doesn't exist anywhere outside of Lofty and has never existed in real estate before, people should be willing to pay more. Like, you want instant liquidity, like you got to pay a little extra to be able to unlock that. And so we as a platform, the way we make money is we don't manage anything for you. So we don't charge management fees. We don't take a cut of your profits or your earnings. All we do is we charge a trading fee. Like if you don't trade, we make no revenue. But if you're buying tokens and you're selling tokens, anytime there's a trade occurring, we have a percentage fee associated with that trade on our platform. And so for market orders, for instant liquidity, you have to pay an additional fee. So you pay our fee, but you also pay an extra fee to the algorithm, right? And to the trading bot. And the bot, it's not a real person, so it doesn't need money. It passes off that revenue to the people that have lent out their liquidity to this pool. So why do people lend out their money? Well, it's because they earn a yield on it. It's basically like debt. Like you get to lend out your money and in exchange make revenue from this, algorithmic trading bot, right? So that's kind of where all the economic incentives tie in. So there's technically two sides of the market. On one side, you have people who are essentially using the liquidity for trading, and these are just the real estate investors. And all you need to do at that point is that, hey, trading is instant. And if I want to use this feature, I got to pay extra money for it. That's it. That's all you need to know. You don't need to understand any of the blockchain concepts, and it will just work for you. Then on the other side, it gets a little bit complicated. Typically people who use it understand these blockchain concepts more, but they're willing to lend out their capital, both equity in the real estate property that they purchase, as well as dollars. They lend these assets out so that they could be used for trading, and in exchange they get a yield. And a lot of times these yields depends on the frequency of trading, and depends on, essentially the more trading that happens, the more fees it collected and the higher your returns. And so in many cases, these liquidity pools will pay out yields in double digits, which you compare to the risk-free rate of roughly 5% these days. People are willing to take the risk on that if they think they can consistently get 20% yield from lending out their assets, right? So that's how they interact with that side of the market. They supply the liquidity. So that's how it works at a high level.
That was a great explanation. It was high level enough for a sixth grader maybe to understand. I'm not sure. It's been so long since I've been in sixth grade. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So It was great talking to you, and see you next time.